Well, nobody expected this one, but Tesla moved only 2.5% after earnings. Prior to the event, it was implying an 8.9% move to happen after earnings. So now that the event has passed and the stock didn't move at all, what's next? Is there still a trade on Tesla? Should we be selling options post earnings? Is there an opportunity to maybe buy options? Or is there no trade at all? In this video, I'm going to share with you my analysis of Tesla options and what I think the best trade to take right now is. If you're new to the channel, my name is Sean Ryan. I'm the CEO of Predicting Alpha. We focus on boring option selling strategies that actually make money. So if you're interested in them, you want to get our strategies, you want our data, click the link in the description below and take a free trial with us. With that being said, let's hop into the video and take a look at this analysis. All right, so here, as you can see, Tesla literally moved 2.44% as of market open. Going over to the terminal, looking at earnings, it was an 8.92% implied move. The stock was expected to have a massive change in value, and realistically, it moved less than it has on average over the last week, which is pretty incredible if you think about it. Now, there was a lot of anticipation going into this event. The options going into the event were 20% higher in value. The implied move for earnings that was embedded in the options was 21% higher than it usually is, which is a big difference. But it makes sense why that was the case, right? If we take a look here, we can see that for the last earnings, the implied move was 7.3%, and then it actually moved 22% by the end of the day. So given that massive mispricing in the last earnings, it makes sense that we see a little bit more uncertainty being priced into what we saw for this upcoming event. Now, something to keep in mind is that Tesla has changed a lot in value over the last month or two, right? Since the US election, pretty much. So we can see here, it was down at 218 a share just back in October, end of October, and now it's up at 400 a share, right? We're talking almost a 100% change in value. So the market's already priced in a lot of movement for Tesla due to speculation about the future. So it makes sense that whatever numbers kind of came out, the move wasn't going to be massive. What would have really driven a big change here is if there was any speculation changes about the future, right? If there's any change in the forecast about what they would be able to accomplish. Looks like we didn't really get much of a surprise there, which is why there wasn't too much of a change. Now back to the question of the hour. Is there a trade right now on Tesla, given that there wasn't this big move? Now, I'll share my direct opinion with you right off the bat, which is I don't think there's actually a very blatant trade right now. But if I were to lean one way or the other, I would say selling options here is probably the better move than buying them. And I'm going to break it down for you now with a couple key data points. So now coming back here into the terminal, I want to first take a look at the implied versus realized volatility time series. Taking a look here, we can see that since the election, there have been pretty extended periods where the realized volatility has been higher than implied, meaning buying options is actually the better move. Selling wouldn't have done too well for us. But we can also see that in recent times, we plateaued around this 70% realized volatility mark. And in the last 10 days or so, it began to taper off, moving down to now being just 60% realized volatility. And at the same time that this has happened, the implied volatility has not changed. It's remained level at around this 55 to 57% mark, meaning that realized volatility is contracting and implied volatility is staying level. So if we continue to see this contraction in realized volatility, meaning that things are not going to be as crazy as they were in the past, all of a sudden selling options becomes a phenomenal play, right? If we continue to see these like 1%, 1.5%, 2% days, all of a sudden this option selling trade becomes really attractive and something that we should be looking at. So that's the primary reason why I would be selling options if I had to pick between buying and selling. But there's one more that we're going to take a look at now as well. The second reason why I would be a net seller of options rather than a buyer is primarily due to this call skew. As an option trader, we always want to be thinking about who's on the other side of our trade. And when I see call skew on a single name stock, I'm always inclined to think that retail traders are likely on the other side of my trade in a lot of cases. Knowing that this is also the second most talked about stock on Reddit, on Wall Street Bets, right after Nvidia, also gives me this inclination that Tesla is one of these stocks where if I were to go out and be selling call options here, it's very likely a retail trader on the other side of my position, especially given that there's this call skew. So that's a secondary reason why I think selling options here is still the right play, even though in recent months, it's not been excellent to do so. So like I said, I would be a net seller, but I also shared with you that realistically, I don't think there's much of a trade here. And now I'm going to share with you the key data point that drove my view on that, which is the variance risk premium over time. So coming back to the variance risk premium tab for Tesla, right? Variance risk premium, you can think of it as the difference between implied and future realized volatility. And we basically use it to say, hey, I might not be able to forecast the future well, but I know that variance risk premium tends to persist. So if variance risk premium has existed for a long period of time, it's likely to be there in the future. And if it hasn't, then it's likely not to. So what is it for Tesla? Well, the average variance risk premium is -2 points, meaning that if implied volatility is on average 20, realized volatility is on average 22. So if we take a step back and we go, okay, well, does this even show or exhibit the phenomena of a variance risk premium? The answer is no. We actually don't see that on Tesla, meaning what we are doing when we sell options here, when we take this short volatility position or long volatility position even, is we're kind of saying that, hey, we know the variance risk premium should be there on average, but we're kind of forecasting that it should be there in the next couple weeks. And forecasting volatility of this nature in this way, it's not the easiest thing to do. So there is a fair degree of speculation if we take a view on Tesla here. There's no overhanging phenomena that's very blatant and prevalent that we should be trading here on this ticker. So that's the reason why I take this neutral stance, saying, hey, I'm not going to be selling options here myself. If I had to pick, I would, but because I don't have to, I'm not even going to be entertaining the idea of trading Tesla right now. But on the flip side, I'm not going to be buying options either. And that's because just because the variance risk premium is not present doesn't mean you buy, because it should be present. The only reason we're looking at option selling or options in general is because of this phenomena. So the non-existence of variance risk premium for a particular underlying over the last 4 years doesn't mean I should be buying the volatility there. I hope that makes sense. If not, leave a comment. I'd be happy to chat with you more about my perspective on that. But if you choose to structure a short options trade here, the way that I would do it is the same way I do it for pretty much everything else, which is I would be selling an at-the-money straddle, and then I would be delta hedging it daily. So if you don't know what delta hedging is, it's basically managing our position using shares or option contracts to maintain that delta neutral perspective, or that lack of sensitivity to which way the stock actually goes. For example, let's say I put on the trade today, and at the end of the day, I have -50 deltas as a part of my short straddle position. What I would do is I would buy 50 shares in Tesla, giving me +50 delta. Each share is 1, and that would give me a sum of 0 delta for the entire position. -50 coming from my short straddle and +50 coming from the shares that I purchased. And then every day moving forward, I would adjust my share position to maintain that neutrality. And that's what would give me the cleanest exposure to the difference between implied and realized volatility. That's pretty much it for this video. There's not really a trade here on Tesla, even though all eyes are on it. The vol is just not high enough for me to justify it. But if I were to take a trade, it would be that short volatility position. I would be a net option seller. And the way that I would do it is I would be structuring the trade using a short straddle that I delta hedge daily. All right, everyone, that's it for this video. I hope you found this analysis helpful. If you have any questions, leave them in the comments. And if you want to join us and just start running some systematic stuff that makes money, click the link in the description, take a free trial with us. You even get some coaching calls as a part of it, and I'll see you there. All right, everyone, take care.